Finding a reputable business shouldn't require luck or chance. But how can you tell who you can trust? Pro tip: the BBB connects people with businesses they can trust. So think of the BBB as the better. Check with the BBB first, because better businesses are honest and commit to high ethical standards bureau. That's why they're better. Always look for the sign of a better business and find a better business anytime at bbb.org.
Our January webinar is, what is your business really worth? As you know, eventually you're going to exit your own business one day, and selling the business is the most viable option for many. But for many business owners, it can take up to 3 years to get your company positioned to sell for top dollar. So Barbara Klein, our webinar presenter, has a couple of tips on how you can make the most of it and how you can start the succession planning for your business. So that way, when the time comes, you have a plan in place. You're not having to, kind of struggle. So without further ado, I'll go ahead and turn it over to Barbara.
Good morning, everybody. I apologize for not having my camera on. It somehow stopped just before the webinar started here. So you'll see a picture of me later. As Austin mentioned, what I want to talk to you today about is how to understand positioning your company for sale. I think as a business owner, probably every one of you has asked at some point, what is your business really worth? There's a lot of answers to that. We're going to go through some of them. But one of the things that I think is critically important, I'm assuming that everybody here today is Main Street, which is gross revenues under $2 million. That's called the Main Street market. There's a lower middle market that is above that, which behaves somewhat differently, but I'll be addressing specifically Main Street market today. And I want you to understand, when we package your business for sale, what the buyer is looking for on the other side, and some of the differences between what a seller is going to think it's worth and what a buyer is going to be looking at. Austin, I think you're moving the slide, so if you could go on to the next one. I think one of the important things for everybody to know is that there are a number of different ways to value a business. There's no one answer to what my business is worth. I'll talk to you about some of the ones that are most relevant for the Main Street market. And the first one is book value. That's what your accountant takes care of and what is reported to the IRS. And it's designed to meet specific accounting methodologies, and is not necessarily, and most often not really, close to what the value of your business is going to be when you put it on the market. There's another item called asset market, and people can, as you'll see later, sellers can sometimes mistake the asset value for the business value. But the asset value is basically a list of all of your hard assets, which may or may not include real property, and their current market value. Even the current market value can be looked at two ways. One is to look at the value if you do a controlled planned sale. The other is a liquidation value, which means that you are just selling it as quickly as possible in order to liquidate your holdings. And of course, that latter one is the one that is going to be of lower value there. For businesses, however, the most important valuations are going to come from what's called market valuation. And two components of that are the multiple of gross revenues, which is taking your gross revenues for the year and multiplying it by some factor that's determined by market research. The other way is a multiple of discretionary earnings, and you'll see how this has more validity as we move forward. But the definition of discretionary earnings is not exactly net income. Most Main Street business owners make choices on what it is they're going to charge, what it is they're going to purchase that are oriented towards providing some owner perks and also towards tax purposes. And some of those can be added back in order to determine what is truly the discretionary earnings that the owner has at the end of the day. That also includes adding back any owner salary that is taken out in the profit and loss statement or the financial statement. Next slide, please. I've been in business brokerage for about 8 years now. Prior to that, I was a business consultant and business strategist. So most of my adult life has been working with entrepreneurs and business owners. And personally, I've also started or co-started 8 businesses. So I have a pretty good feel for what an owner is thinking and expecting. And some of those things, and you'll see why this is a challenge, is reward for investment in the company. I've seen business owners that said, well, I just put, X $100,000 into remodeling my restaurant, so that needs to come out of the sale price. Or my building is worth so much, so clearly the price of the business is going to be adding that to certain numbers. You'll see that is not necessarily how these things are calculated. Sellers looking for a reward for hard work. Hey, I've been doing this for 15 years. I expect to get so much out of it. Again, understand totally, but the buyer's objectives are going to be a little bit different. Reward for personal achievement. Gee, my business has been #1 on the annual best of businesses in Albuquerque sites. It clearly has value for that. And another area where some sellers are building their expectations is they're looking at multiples that are typical in Fortune 500 companies and trying to apply them to Main Street markets. If you follow the stock market, you'll see that some companies are selling at multiples of 10, 20, 30 more times their annual earnings. And this is because there's a very different mentality in that market. It is investors who are looking at the management of the company and market areas and basically placing a bet on what the future is going to hold. When you're talking to a buyer in a Main Street market, that buyer is most often going to be someone who is going to be an owner-operator who is investing a significant amount of their life savings into this business and who is going to be considerably more risk-averse than that that Fortune 500 investor. And so the multiples are going to be considerably lower. They typically fall in the range of 2 to 3 times your seller discretionary earnings. Next slide, please. So let's talk a little bit about from the buyer's side, because I think this could be very instructive. A buyer is basically going to try to decide if the purchase price makes sense. The buyer is going to be looking first and foremost at cash flow. And particularly if they have a financial advisor involved, the financial components of the sale are going to be something that comes up regularly. The operation processes and procedures and all that are important, but that financial aspect is critical. So what does a buyer want to be able to cover with the cash flow that comes along with this business? The first thing is they want to cover debt service. Debt service, of course, is paying back whatever loans or contributions you were getting to buying the business that the person who provided the money is expecting to get back. In a business, a business is typically expected to be paid for within 3 to 7 years. If you have real estate associated with it, it can be up to 25 years. But there is a monthly payment that's expected there, and the cash flow of the business is expected to cover it. Bear in mind that this is an owner-operator, so they are going to need income that's going to support at least their basic needs. This can often be an owner may be willing to cut back in terms of how much money they're getting, in terms of betting on how they're going to be able to make the company grow in the future. But they do need to be able to keep their kids in clothes, put food on the table, pay their mortgage, and other things that any citizen is going to need to do. They're also, I'm going to skip down to that fourth bullet, they're also looking for enough money left over to fund some reasonable growth. They've just made a big investment. There's going to be things that they want to do or change inside the company, and they're going to need some money available to do that. The final thing is that when you're looking for money from a buyer, one of the things that the buyer is looking at is where they could place that money for other returns. For example, you're competing in a way with the stock market. If they put their hard-earned money into this business, what kind of return is it going to provide? Or gold, or Bitcoin, or whatever you want to look at. But do understand that there is a financial component where somebody is going to be saying, well, if I put my money someplace else, is that going to be better for me financially? So, with these things in mind, you can see that some seller expectations are not necessarily what the buyer is going to be looking for. I'm going to give you a sample of a buyer's sanity test on the next page, and if we could go there now. This is a very basic test that a buyer can look at in order to determine what price they're willing to pay for a business. And I'm using an example here that actually is very close to something that one of my clients was trying to do a few years ago, and it was a tough situation. I didn't like having to be the bearer of necessarily bad news, but I think it's going to help you understand, again, how your business looks and how it is judged when somebody else is looking to purchase it and take it over. So this first line here is discretionary earnings. This is how much the company returned to the owner at the end of the year. It includes the owner salary. It also includes because there's real estate involved in this, it also includes any rent, because the rent is going to be substituted by the monthly debt service payment. That's going to be included in that since it's real estate. The owner was looking for a price over $500,000. So you calculate, first of all, the down payment, which is typically around 20%. We're looking at a bank loan here. If you were actually looking at a owner financing strategy, that number would probably be 30 to 50%. So, it's something that you have to bear in mind. It's something that a buyer is going to be looking at. So you get a balance that's to be financed. In this case, because there is a real estate involved, we can look at a 25-year term. And this rate, which you might notice is a little bit lower than today's rate, but it's here for comparison services. we're looking at 6.5%. So the monthly debt service in the range where the seller was looking to sell was between $2,700 and $3,000. So you multiply that out by 12, you get an annual debt service amount. And then you subtract that from the discretionary earnings. At this point, you can see that at $550,000, you're actually negative before you even get to the owner's salary and benefits. At $500,000, you've got a little bit of money coming in, but nonetheless, after you subtract owner salary and benefits, you're going to have a negative number. Now, if the owner is looking at this as a lifestyle business, and a lifestyle business means something where the owner is looking basically to create a salary for his or herself, but isn't really looking to grow and build a business and have employees and things like that. You can look at the discretionary earnings and this kind of estimated owner salary and benefits, and you can see at these higher prices that it's possible that a buyer might be interested because it's going to cover what they're looking for in terms of annual income. But if you're looking for someone who is expecting to grow the business, or if you have multiple employees in the business, that return is probably not going to be something that's attracted to them. And then down at the bottom, you have your comparisons to see what kind of return your money is getting. The ROI on down payment, or return on investment on down payment, is definitely a negative, and that's the return to buyer after debt service divided by the down payment. The ROI on purchase price is going to be different, and the ROI on purchase price is basically looking at dividing debt service by the amount left, or the debt service minus the amount left over by the price. So it's that negative $2,117 in the first column there. It gives you a different number, and you can see that as you work through the different numbers on this schedule, at $250,000, you've got a return on purchase of 7%, which someone may be attracted to, but typically, because of the risk of a business, buyers are looking for something above a 20% return on purchase price. So this was a very difficult business to look at. And, I mentioned that, for example, if the buyer was simply looking to buy a business or buy a job and was looking at only a lifestyle salary, they might find this attractive. Another buyer who might find this attractive would be someone who saw value in the business that was, or in the property that was beyond what the business was returning. You can see this kind of example if for example, someone bought a large building and only occupied part of it and hadn't rented out the rest. Or if the new owner wanted to move the business out of the building and put something else in the building that would provide a revenue stream that would make the property purchase attractive. So this is not an impossible scenario, but it does significantly reduce the number of people who would be interested in purchasing this offer at the types of prices that the owner was looking to get. Next page, please. I want to give you an example. We talked about the two market value numbers that people look at to create a multiplying effect are the revenues, gross revenues, and discretionary earnings. So I want to give a couple of examples and show you how a buyer is going to look at these. In the first one, we're talking about two companies that have the same amount in sales, $1 million. And one company is returning $10,000 in discretionary earnings, and the other company is returning $100,000 in discretionary earnings. Companies are harder to value than, say, residential areas or even companies on the stock market, which are publicly reporting a number of their financial statements. But in a situation where you're evaluating a company for the Main Street market, you can see, I hope, that just because both companies had $1 million in sales, they probably were not equally attractive to a potential buyer. The other side on discretionary earnings is a different way of looking at things, and this is where sellers sometimes have a little bit of difficulty in understanding how a buyer is going to react. We're talking about companies that both have $100,000 in discretionary earnings. And in one company, there's $5 million in real estate. And in the other company, there's no real estate. They are renting space. They have $1 million worth of furniture, fixtures, and equipment. And the question is, how is a buyer, and therefore a business broker, going to evaluate these two companies and come up with an idea on their value? Next slide, please. It may have been fairly clear to you on the left that the two companies with $1 million in sale, one was returning discretionary earnings of 1% of sales, while the other was returning discretionary earnings of 10% of sales. And so even if the buyer can see by looking at the financials that the top company is capable of returning more in discretionary earnings and is willing to buy the company based on their expectations that they can make changes, they are not going to pay the same price for it as they would for a company that was already demonstrating that it was able to make those returns. On the other side, it may not have been so obvious, but this is where, you know, a lot of sellers that I have talked to have had a little bit of difficulty. They say, I have $5 million in real estate that's in this deal. I should be able to get a lot more for it. But when you look at the return on assets, that $5 million in real estate with the business that's currently installed in it is only providing a 2% return on assets. Whereas the company that is renting and has $1 million in furniture, fixtures, and equipment is providing a 10% return on assets. This again is a critical component in looking at how much you're willing to pay for a company. Now, all is not lost in the first one. This goes back to what we were talking about in the buyer's sanity test, is that it might be reasonable and possible to split the company from the real estate and offer the company, or possibly move the company to another site, or have the buyer move the company to another site where the expense of the real estate or the loan or the lease wasn't so high, which would cause the company to be more profitable, and then sell the real estate on its own for the value. The business and the real estate in this case don't absolutely have to be attached to each other. But it's important to understand that if the seller or the buyer expects the two of them to be associated, they're going to be willing to pay considerably less for all of that real estate with that business in it than they would for a business that had considerably, was returning the same amount of money with considerably less investment in assets. If you have any questions about that, we can talk about it in the Q&A later, but I think it's a really important point to consider as you're considering what investments you're going to make in your business. For example, I talked to someone recently who had invested about $8 million in equipment. It was very asset heavy company. And he had just achieved $1 million in sales and was looking to get some kind of return now that he was $1 million for all those assets. So he was expecting to be able to sell the business at a much higher price than cash flow would justify. And my recommendation to him was to, liquidate and just, if they wanted the business along with it, that was great, but basically just sell the assets to someone. Next slide, please. We don't have a lot of time in a 1 hour webinar to really get into details, but I hope I've given you a little bit of food for thought here. So let's talk about a few things that you can do at whatever stage of business you're in. Whether you just started it yesterday, or whether it's in a growth stage, or whether you're seriously considering liquidate or exiting in the near future. And the first thing is to plan ahead. A lot of small business owners, because of decisions that they've made for tax reasons or other reasons, may not be showing net operating income and discretionary earnings that really justify what the real value of their business is. I've talked about the fact that it's possible to do some financial recasting so that a buyer can see what we'll call true operating expenses are, and then they can make a determination whether they want to use more expensive equipment or nicer real estate or whatever, and use up some of that money that the current owner has been using. But banks are pretty strict on what they will and will not consider in recasting. So that bottom line net operating income is a really important line. So if you're planning on getting out of a business, you want to plan at least 3 years ahead about really getting serious about what your net operating income is going to look like. With COVID in the way, I often look back 5 and 6 years so that we can develop a trend that kind of ignores 2020 and 2021, which were exceptional for some businesses because absolutely nothing was happening, and for other businesses like home remodeling, which just absolutely soared in profitability during that period. But there are other circumstances you need to think about. What if a partner decides to leave or wants to sell out? What if the owner is in the process of a divorce and the business needs to be liquidated to satisfy the conditions of the divorce? What if the owner gets ill or gets burnt out? I've had people come to me and just say, I can't even do this one more day. It's a reason to think about net operating income and how you are going to display that earlier than just at the time that you're thinking about your exit strategy. You want to replace yourself. We talked about lifestyle businesses a little bit earlier, but if you have a business that has multiple employees and is a business that the new owner is looking to buy and build upon, they are going to see more value in the business if there is management in place that is able to do part or all of what the owner does. I had one owner and I loved him dearly, but when somebody would come in to talk about it, they'd say, well, who does the design work? And he'd say, I do. And they'd say, well, who does the sales? And he'd say, I do. And they asked, who does the financials? And he said, I do. And the question that came back was, well, where is the value in this business? Because when you leave, all the skills and knowledge and relationships are going to go with you. So you want to think about building out that team so that when the owner leaves, some of that team will be in place as a core infrastructure for the new owner to come in. If you really want to optimize the value of your company, you're going to work on growing it. Buyers buy and lenders loan on numbers. The greater the net operating income you have, the more easy and likely it's going to be that you're going to get your number in a sale. You want to understand the business, the value of the business, and the tax consequences of structuring the deal. Value of the business is one component. How the business is valued and how the IRS is going to look at it is another component. And this needs to be discussed early on in that planning strategy. And finally, I'm going to strongly recommend that you make sure that you've got a financial planner involved early on in your business, because for most owners, a business is going to be a major component of their retirement plan. And if you don't know that there is going to be a major hit tax-wise, either through income received, which some of the sales price is going to look like, or capital gains, you could be in for a big surprise at the time the sale is actually completed. I'm not a financial planner, and so I'm not going to go into the dynamics of that, but I just do want to mention that people have been surprised when they look at the number that they think they're going to get, and then they see what's actually going to be there after their taxes and sometimes, debt that's sitting on the balance sheet is taken care of at the time of sale. Next slide, please. So we're wrapping up here. I want to mention, and I hope this is good food for thought, is that a business broker, along with a financial analyst, your CPA, and a strong business attorney are an important team for you to have as you're moving into the process of selling your business. A lot of owners try to do it on their own, and some of them are very successful, but unfortunately, most of them will say later that they really wish that they had had somebody else involved. As an owner, you want to do what you're good at, which is running your company. You don't want to be distracted during the sales process. And you probably want the resources of somebody that does that for a living. For example, my job is to sell businesses, so I spend every working minute working on that part of the equation. The experience that I've had, the situations that I've had to deal with, the learning that I've had, all comes to you when you talk to any business broker and use them to assist in the sales process. Next slide, please. So I hope that this has provided some thought for you. I know I've left some time for questions, and I'm looking forward to talking to you about anything that comes to mind. And this is my contact information. I do offer a free half-hour consultation to anyone at any stage of their business to talk about how an exit strategy could impact their current decisions. So thank you very much for your time, and I'm here to answer questions.
If you guys have any questions, you can also type them in the chat or in the question section. But I believe I unmuted everyone, so. And if you don't have any questions right now, like Barbara had mentioned, she does offer that complimentary consultation where you can reach out to her. And I will also be sure to send out her information in the webinar recording as well too.
Okay, well, thank you very much for the opportunity. It was a pleasure talking to everybody today.
Awesome. Thank you all. Well,
Finding a reputable business shouldn't require luck or chance. But how can you tell who you can trust? Always look for the sign of a better business and find a better business anytime at bbb.org.